Why is investing so dang important? I'll give you 5 reasons in this video, and I'll even throw in a unique bonus in the end that you may not have realized before. This is episode 8 of our 2021 Money School, where we go back to basics for personal finance and investing. My name's Hervin Pesa. I'm a financial planner, but just like you, I'm still on this journey to building wealth and financial independence. And this channel aims to provide you with money lessons no one taught you in school. And to run towards this goal, we're publishing a video every single day in September, so be sure to subscribe and hit the bell so you never miss any of our lessons. Reason number 1, $1,000 kept in cash under your mattress from 2001 until this year is gonna buy you about $700 worth of stuff. That's like less, right? And if you put $1,000 in a savings account since 2001, you'd have $1,411 today. However, if you invested that $1,000 in the same time frame, you would have about $2,900. So it's 3 times more than what you put in. I feel like that alone is enough for me to just drop the mic and end this video, because I have another 25 to do, but I'll just get someone else to drop the mic for me. Do you know who else will agree? Bernie. I am once again asking you to invest consistently. See, this is so important, and it's such a true bipartisan topic. That's because keeping cash long-term beyond your emergency reserves will make you poor. While saving alone means having to work hard forever for your money. And whatever you do save will likely be insufficient for the lifestyle you want to maintain in the future. Remember, saving will give you $1,411 after 20 years of keeping that $1,000 locked away. Well, according to the Bank of Canada's official inflation calculator, you would need $1,446.14 to buy what $1,000 would have bought you 20 years ago. In this case, you were disciplined enough not to touch the cash, but you still came up about $35 short. That's the first reason to invest. If you want to outrun inflation, the only real way to do that is by investing in buying assets that will grow in value over time. Reason number 2, if you simply save, you will have to work really hard, personally and physically, to get the same result. With our second video, we talked about Vicky and Samantha. They're a 40-year-old couple who are 25 years away from retirement, and we want to figure out how much they really likely needed to save, given their goals, their lifestyle, and what they want to accomplish. For them, it ended up being about $1.3 million. That's in 25 years. They already have $180,000 today based on their current savings. Using a 6% return, we estimated that they would only need to set aside $718 every month, or about $360 each. Now, once the RSP matchups at work are considered, that's very attainable. If you haven't seen that video, I highly suggest you go there. You're gonna pick up a few things. Now, what if Vicky and Samantha stashed that contribution into a savings account instead, and they got a very generous 1% return? They would miss their goal. They would miss the mark significantly. They would end up with about $500,000 in savings, which is a lot of money, but that's 1/3 of their required capital for their retirement. If they were stubborn and they didn't want to invest, they can choose to keep doing that, but they'd have to retire at 85 years old, about a year or two under their current life expectancy, so they can enjoy about 2 years of retirement. Now, notice that after I dropped the assumed rate of return from 6 to 1%, they actually needed nearly $1.7 million instead of 1.3 to retire. That shows you that a low return in retirement means having to build up a bigger nest egg. So saving and being hyper conservative costs you more capital in more ways than you can imagine. Based on the calculations, to meet their current lifestyle needs, at a 1% return, they would need to save an additional $32,700 every year. What? So you need to get comfortable with growing your money. And if you're not investing because of risks, that's tomorrow's topic. So be sure to subscribe so that we can show you what you need to learn. The third reason Becoming an investor means you are gonna get preferential tax treatment. See, by becoming an investor, you are an asset owner. These assets grow in value. In most cases, you don't have to pay until liquidation or when you transfer ownership to somebody else. When you work actively, you earn T4 income or self-employment income. You have to report 100% of that for your income taxes. On the other hand, the tax code is set up to favor investors. Look at capital gains, for example. If you have a capital gain, you're able to sell your asset at a higher price or a higher value than the cost that you acquired it. However, you're only gonna pay on the growth, and half of that is what gets added to your taxable income. See, this applies to real estate, stocks, and even high value collectibles such as art, jewelry, cars, and sport cards. When you mention investments, it's easy to think of stocks alone, but appreciation of other items can be looked at as investments. When you work year over year, you pay for taxes, while with the right asset class, with the right investment tools, you can grow your assets without having to pay any taxes on that appreciation. Sometimes this could be tens or hundreds of thousands in a given year. Investing in a Canadian business that pays dividend also generates tax credits, making them significantly more tax efficient than your hourly or salaried income. So take advantage of these tax hacks. Reason number 4, if you like free money, invest, because some investors get free money. See, if you work for a company that provides an employee match on their retirement plans or stock options or purchase plans, take advantage of it. You may work for a company that has a matching program where they match your contributions to your RSPs up to a certain limit. If you ignore this, you can be leaving thousands of dollars each year, or worse, tens of thousands or hundreds of thousands of dollars for your retirement. One of my current clients works for a company that has an RSP matching program, and he's been there for years. They match up to $3,200 a year, or just under $270 a month. He hasn't taken advantage of it. One of the key action items for us is to get him enrolled. If he works for the same company for the next 30 years, because he's a young guy, it's gonna be worth about 300 grand. Yeah, that's a lot of free money on top of his own savings. And all he needed to do to capture it was put aside $130 each paycheck, which he should have been doing to begin with. See, he was expecting me to recommend a fund or use the benefits that we have here, but the benefits of the matchup that he already has access to is far too significant for me to manage or recommend for his portfolios directly. If you have a matchup program at work, you could be leaving a few hundred G's on the table. So make sure you look into this. If this is your first foray into investing, you're gonna be ahead. Reason number 5, investments buy you time. See, most of us, especially those early in our careers, trade time for money. And this exchange is gonna be lopsided. Your employer would typically get more value out of your labor than the dollars that they gave you. Otherwise, you're not worth keeping around. That seems harsh, but this asymmetrical exchange happens whether you're a 15-year-old barista earning minimum wage, learning how to draw flowers and trees on foam, or whether you're a lawyer earning $250,000 a year. However, when you save and invest consistently enough for a long enough period of time, you will get to a point where your assets are working hard for you instead of you working hard for money. The hope is that they'll work so hard on your behalf that the growth and income can generate more than what your lifestyle costs. This is what most people call financial independence. Some wait until they're 65 or at retirement before this gets to happen, while others get so focused and obsessed about making this happen that they pull it off before they're 40. Now, regardless of when your planned date is, the goal is likely to have the freedom with your time to do what you like with the people you love and spending time with them instead of spending time to earn a living. Investing long-term and allowing compounding to work for you can be super powerful. However, compounding can take a while to truly become visible. So it requires a ton of patience. Or, as Charlie Munger puts it, the first $100,000 is a... So let me give you a perspective that I hope will give you a little bit more patience, especially if you're a younger or you're a newer investor. You might receive a statement after a year or two of investing, and all you're seeing is a few $100s in movement, and think, big whoop. This lack of excitement makes it easy for us to give up and pull out of our investments early and just stop and just don't make any more contributions. But think of the dollar movements in time. How many hours would you have had to work to earn the $200, the $300 change? Well, you need to work for a day, 2 or 3? That's what your investments are buying you. You're potentially earning that without you having to work. And do that for a long enough period, all of a sudden, instead of it buying you days, it's buying you months. Maybe it'll buy you a year or 2. On a side note, you could see a statement and it looks like it's a drawdown, showing you a paper loss. The same thing still applies. Your wealth can move up or down with equivalent to 2 or 3 days worth of work without you having to put in time. So don't look at the negative, look at it as the dollar amount going up and changing. Reason number 6, by becoming an investor, you can change the world. OMG, that sounds like hyperbolic, sentimental drivel, right? But it is so true. Many brilliant items and services that we use today exist because of the capital markets and investors. Yes, there are ventures that would fail, but there are also some that will break through and change the world. Think Amazon, Airbnb, Netflix, YouTube. Look at YouTube. YouTube changed entertainment and education. Right now, I'm talking to a camera, which was produced by a manufacturer in the hopes of generating profit for its shareholders. And then the file gets uploaded to a free platform, on a platform that allows me to share my opinions and ideas, which hopefully helps you. It's free for both of us because of the ads that Google runs on it. The investors in Alphabet then earns a return, which helps fuel their long-term plans and so on. But what if the initial investors never backed Chad Hurley, Steve Chen, and Jawed Karim? It's very likely that we would have a very different digital world today. Angel investing and venture investing is not suitable for new investors, but if you invest, you can still help shape the future with investments through socially responsible investing strategies. It's a way of investing that filters companies you invest in, not just by the dollars and cents of profit and financial statements, but also by their social impact. We'll do a separate video on socially responsible investing, but I can only imagine if companies who need capital soon get forced out of funds because they don't meet the ethical practices, they'd likely change for the better. So I bet you weren't expecting that. That's a bit of a bonus. Let me know if any of these reasons resonate with you. Hit me up in the comments. If you haven't done so already, please subscribe and tune in for tomorrow's lesson. Until then, stay aware, take control. I love y'all. Bye. Be sure to watch yesterday's video.